Well, good evening, everyone. Welcome to this first edition of the Financial Fitness Worldwide webinars for 2025. We have a great lineup for you this evening, coming from Johannesburg and London. So we're covering the bases, north and south, to make sure that you guys get a good impression as to what we think might be happening and what we would be looking forward to in 2025. Thank you for attending today, and please hang in till the very end because we're going to cover some interesting and potentially controversial questions, which I'm sure you're all interested in. So our first guest tonight is Mr. Peter Little. We have the privilege of having Peter on our investment committee at Financial and Fitness Investco. Peter was born in South Africa, educated here, and then moved to the UK when he qualified, moved to the UK in order to start working in the big league in Barclays Bank, Royal Bank of Scotland, people like that. He then went to New York and worked for JP Morgan and then finally Credit Suisse. So gaining a lot of experience in the financial markets overseas, which is really highly valuable in this world that we live in. And then came back to South Africa in 2013 and is now a portfolio manager with Anchor Capital. And as you know, we work very closely with Anchor Capital and have an association with them. So I think you're going to enjoy this first 30 minutes. In fact, you're going to enjoy the whole thing. But Peter's going to speak to us about the ripples across the globe from a South African perspective and what's important to us. So Peter, would you like to come online? And here you go. There he is. There he even looks as good as the introduction. So one of Peter's favorite sayings to us when we're having our Investco meetings is, if it looks perfect, then you probably overlooked something. So he's a mine of data and information. So thank you, Peter. I'll hand it over to you.
Perfect. Thanks, James. Thanks for the intro. Let's get cracking. Really big thank you to all of you for taking the time to listen to us and myself from the comfort of your homes, hopefully this evening, and hopefully we'll keep you entertained. So as I get my slides up here, I would just like to say, Jim mentioned I sit on the Investco. I've had that privilege for the last few years, I think 2 or 3 years. And what I can say to you guys as clients is that you're really fortunate to have that team working for you. They do their utmost to make sure that not only are the people like myself and Dion who are kind of managing your hard-earned savings, keeping our eye on the ball, but that we're doing it at our best price. So I think you're getting a great deal out of a really fantastic team. So Jim mentioned I was going to talk about kind of what's happening out there. A lot of what we try and do day to day, frankly, is just kind of filter through the noise that's coming out at us and try and figure out actually what really matters. A lot of the news that hits us creates some sort of emotive reaction. But what we're really looking for is how much of it is going to impact our investments and our economies, and how material is that, and can we focus on that stuff? So that's what I'm going to try and cut through this evening. I was going to spend a slide just talking about South Africa, and I was actually trying to talk on the budget, which I guess it got pretty interesting from a perspective of, it's going to be announced and then they had to pull it back. But frankly, when I looked through all the data, there was really nothing interesting to talk about. The most interesting thing I think was the VAT. But what I did dig out of there, just to try and put it into context, is how our government earns its revenue. And so on the left-hand side here, this is a chart courtesy of SARS and Edward Kiswetter and his team are doing a great job of trying to rebuild that institution. They get some really good data out to people looking at what's happening from our tax-based perspective. But the blue bars here are just saying that most of our tax revenue for our government comes from personal income tax. It's come down a little bit over the last few years. It's down to about 35%, but it's still a pretty meaningful chunk. On the right-hand side here, you can see kind of how much of the tax base. So there's I think 7 million registered taxpayers, of which about 4 million of those fall below the tax threshold. So 3 million people actually paying tax. And if you look at those guys, about 80% of them, or 80% of us, are paying only about 25% of the taxes. So this, massive revenue line for SARS is coming from a pretty tight circle of people. And I think, when they're setting the budget, you kind of understand that lemon's pretty hard to squeeze too much more out of. So skip down to VAT, which is made up fairly consistently about a quarter of what our government earns. And that was the lemon they try to squeeze some more. Frankly, our VAT rate is kind of middle of the line. So if you look at, what countries are charging around the world, we're neither cheap nor expensive. So there is a bit of scope to increase VAT. And I think they've proposed going for 0.5% increase this year and another half the following year. Just to put those numbers into context, so a 0.5% increase on 15% is about 3 and a bit percent, and it's a quarter of tax revenue. So for that 0.5% increase in VAT, the government makes about 0.8% more revenue. So it moves the needle, but not particularly dramatically. I think this chart on the bottom right here, this is the one for me that if they really want to make a difference in the country from a perspective of running the government running a balanced budget, they actually just have to grow the economy. What this is a chart of, it's called revenue buoyancy. And it basically, all it means is this number you multiply. So if we add 1% of economic growth, you get roughly 1.2% more tax going into the government coffers. So they get quite a good multiplier effect on that. And so the best way that our government can kind of balance its books is actually just to make sure that the economy has no impediments to growing faster. So kind of, fixing the rails that economic activity happens on, be that physical rails in the form of Transnet or roads or ports, longer term education, etc. But they should be really focusing on growth, and that will, solve a lot of our problems. But skipping back onto kind of the crux of my talk here tonight is about what's happening outside of our border that matters. And again, for me personally, it's always just about creating some context, like what actually matters. So these three regions, the US, Europe, and China, they make up about 30% of the global population, obviously heavily skewed to China with its 1.5 billion people. But they make up about 60% combined of global economic activity, with the US well out in front here. So more than a quarter of global economic activity is being generated by the US. From an investment perspective, when we're trying to grow your hard-earned savings, about 50% of the stock market capitalization that we can invest in globally is in the US. That's been an extremely well-performing stock market. Some would argue perhaps too well. The reality is only about 30% of stocks, of the profits from stocks listed in America, comes from America. So, it's an attractive destination for multinational companies to list themselves. And so, a lot of the kind of more attractive companies are focused there, even if they're not focused on the US economy. So that's an important one for us to focus on. For Europe, a very small stock market. Most of their really good big businesses are privately held and passed on through the generations there. They're not as keen to kind of create monetization and exit strategies. China is getting bigger. I had to include Hong Kong in this number. So Hong Kong is about 8% of this number. So more Chinese companies listed in Hong Kong or certainly from a size perspective, than in China. But it's getting bigger, but still, the US is pretty much all it's about out there. And then I'll talk a bit about trade later, but just for context here, the US exports much less than its imports. So this is as a percentage of global exports. About 8% of them come out of the US, about 13% of imports. So the US is a big importer. China is kind of the mirror image of that. It's a big exporter, not importing as much. And then the EU is kind of somewhere in the middle of those two. And then again, just for context, South Africa here, certainly from an economic and investing perspective, in the global context, we're tiny, sort of less than 1 or less than 0.5% of economic activity in South Africa. The third of a percent of the global stocks are listed in South Africa, tiny in terms of global exports and imports. So these are the three that we'll focus on. And actually, frankly, for today, most of what's happening that I find meaningful is coming out of the US. But let's start by saying, okay, like these ripples coming in from offshore, how much do they matter? How much of the stuff happening out there impacts our economy and our investment? And I've tried to put it into 3 charts to show you that. So if I start on the left-hand chart over here, this blue squiggly line is economic growth in South Africa. So when it's above the 0 line, this is our South African economy growing. And then I've put all the US recessions in gray shaded bars over here. And what you'll see is if there's a US recession, it almost always has a pretty significant impact or downward impact on South African economic activity. So I've said if you go back 60 years, it's very hard outside of this brief recession in the late 70s in the US, find a period where the US went into recession that didn't have a massive impact, negative impact on our local economy. So from an economic perspective, the US sneezes, we catch a cold. The currency is always an emotive one. So, I think a lot of South Africans feel like the Rand is basically our very public scorecard. So, when the Rand goes tumbling down, it feels like the rest of the world is saying, what have you guys on the southern tip of Africa done here? You're screwing things up, your currency is going to get hammered. But in reality, I would argue the majority of what happens to our currency has nothing to do with South Africa. And the way I've tried to show it on this chart is to say, if I go 30 years back and I compare and I look at the performance of the US dollar index, now that's the US dollar against its global developed market peers, the euro, the Swedish krona, those types of things. And this chart says in 2024, if this bar is pointing right, the dollar was stronger against its peers, weaker in the previous year, et cetera, et cetera. And then I've created the same chart for the Rand against the US dollar. So when the bars are on the left here, it means our Rand is weakening against the US dollar and vice versa. And what you can see is that about 70% of the time, the Rand is just mirroring what's happened to the dollar. If the dollar's strong, the Rand's weak, and vice versa. So I would say the majority of what happens to our currency actually has nothing to do with what we're doing here in South Africa. And then the final thing is our stock market. So similar type of chart, bars to the right here. These are the US stock market returns. And 86% of the time over the last 30 years, if the US stock market was up, we're up. If the US stock market is down, we're down. So we take huge cues from a stock market perspective, from a currency perspective, from an economic perspective about what's happening outside of our border. We really do need to pay attention to what's happening there. And frankly, what happens there, a lot of the noise coming at us at the moment is from the US. They've obviously had a regime shift. There's lots of activity out there. Trump has come into the White House on the 20th of January. He's issued a lot of these executive orders, and these are basically writs that he's signing saying, okay, this is what has to happen in our country. And a lot of it's impacting outside of the borders. So he's saying, for example, internally, our diversity hiring policy needs to change. We need to put tariffs on imports from Canada. All of these things are coming in the form of executive orders, a writ that Trump signs to say this is how we're going to do business going forward. And so I wanted to try and contextualize his activity. And so first on the left-hand side here, what I've said is if you take each 4-year presidential term, going back as far as Eisenhower in 1953, how many executive orders did each president sign in that 4-year period? And here's Trump's first term. So he signed 226 executive orders in his first 4 years in office. At the time, that was as much as anybody since Jimmy Carter in the 70s had done. So he was pretty active in that first term. But his second term, this current term has been, even more hectic. So been in office about 58 days now. He's issued 89 executive orders. So I went back and did a similar exercise, but I said this time just look at the executive orders signed by other presidents in the first full year that they were in office. And if you look at these 89 orders that Trump signed now, no one going back, 80 years has signed more executive orders in a full year. Trump's only done this in 58 days. And in fact, he's on track to surpass the 130 odd executive orders that Harry Truman signed in 1945 in the wake of the Second World War. In a year, he signed 139. At this rate, Trump will get way past that. So what's happening is pretty chaotic from a change perspective. And obviously, as we know, change creates uncertainty. And so the way I've tried to show that here is there's this economic policy uncertainty index created by this crowd, Baker, Bloom, and Davis. And I've looked at that. It's this blue squiggly line here. Looked at that going back 30 odd years. And you can see that the current level at 400, the only time it's been higher in the last 35 years or so is during the pandemic. So it's extremely elevated. There's a lot of uncertainty about which way the US economic policy is going. But interestingly enough, if I look at stock market volatility, so the amount of uncertainty that investors are pricing into what's happening in the stock market, which should be pretty closely linked to the economy, usually attracts, if there's spikes in economic uncertainty, there's spikes in uncertainty about investment in the stock market. This time there has been an increase, but not nearly to the same extent that we've seen in economic policy uncertainty. So it's almost like investors are giving Trump a lot of the benefit of the doubt. That said, the economic activity or the uncertainty that we've seen has done a reasonable amount of damage in the last few weeks or so. So I've taken three indicators going back to the beginning of September, October last year, and that's the period. So in terms of the timeline for the current US administration, the voting happened at the beginning of November. The results came out at the beginning of December. Trump went into office on the 20th of January. But you could say probably from like early October, investors were starting to price in a reasonable probability that we were going to see Trump in the White House. And over that period, what you've seen is the US stock market from the beginning of October started to rally. So investors were saying this is, if Trump gets into the White House, it's going to be a pretty good thing for investment markets. So stocks are going up. You talked a lot about tariffs, so we're saying, okay, that's probably going to be inflationary. We're going to have interest rates going up. So that's the squiggly gray line over here. Interest rates were going up, but stock market's going up at the same time. So the economy is strong enough to bear those higher inflation and interest rates. And the dollar is going to track that stuff along as well. If the US economy is strong, the rates are higher, pretty good for the dollar. Most of that's unwound over the course of the last 4 weeks. So investors saying, hang on, where we were saying Trump was really good for the US economy and for US corporate, perhaps we need to take more of a wait and see approach and ensure that, as all this change is happening, nothing breaks along the way. So that's investors had given Trump quite a lot of the benefit of the doubt. It allowed him to do a lot of stuff. They're now saying, okay, we need to make sure that this change is happening in the right direction. Just on the right-hand side here, I've taken this period for the US dollar. And this is just to reiterate my point about how much of our currency movement happens outside of what happens in our borders here. So all of the currencies have been strong against the US dollar recently during this period. South African rand right amongst them there. You would be hard pressed to look at just South African news over the course of the last 4 weeks and say, our rand deserves to be stronger because we're doing everything so well. But yet our rand is stronger. And that's, again, just to reiterate that point that what happens outside our borders matters a lot for our currency. I'm not going to spend a lot of time on this, but I thought it was interesting context for that awkward meeting we saw in the White House a couple of weeks ago with Zelensky from Ukraine. Um, this is some data from the Stockholm International Peace Research Institute. They suggest that globally there's about $2.5 trillion spent on military last year. For context, the South African economy is about $360 billion. So, 8 times more spent on military last year than the entire South African economic activity. And the US makes up almost $1 trillion of that $2.5 trillion. So almost 40% of the world's military spend comes out of the US. If you go down a level to NATO, so 30 countries, the US, most of EU, UK, and a handful of other countries, they spend about 1.3 out of that total of $2.5 trillion on military. The US, although it's one of 30 countries in NATO, only spent 72%. So the US is spending at a much higher rate than the rest of its peers. The new administration is fairly Darwinian. They have a sort of a pecking order that they like to see. The rest of the NATO members tend to be much more egalitarian. I think this regime is saying, listen, if you want to have your influence on how conflicts are decided, you have to spend up, or we're going to come in and enforce our will. So basically put your money where your mouth is from a military spending perspective. The other thing we've seen from the US administration is a lot around trade. So lots of data on this slide. I'm going to focus first on the South African stuff and then on the US stuff. So from a South African perspective, these numbers here are economic activity of exports relative to our overall economic activity. So for example, South Africa's exports to China make up about 11% of our economic activity. The EU 18%, Africa's 27%. Here's the US at 8%. So we've obviously had a bit of a bit of conflict with them. We're worried that potentially impacts our exports to the US, and obviously it might. So two things to say from this. One, they're certainly not our biggest trading partner. We've got, we would do much worse to annoy the likes of China or the EU, certainly Africa. A lot of our exports go to there. Having said that, though, 30% of our economic activity relates to exports in South Africa. Even a giant exporter like China, only 20% of their economic activity is in the form of export. So exports are critical for our economy, and we can't even afford to lose, 1 or 2% of that. So we should do our best to hang on to that, but certainly not our biggest trading partner. The other thing I want to say on trading activity, the US is a huge importer of goods, and the current US regime is using that to kind of weaponize that. So what imports are essentially doing is the US is buying stuff from other countries, essentially exporting economic activity to those regions. So saying, you make something in China or the EU or Canada or Mexico, it's going to create jobs, it's going to create income, going to create profit for those companies, and you're going to sell it to America. So we're sending you some economic activity that you want. We're sending a disproportionate amount of economic activity to these 4 regions. So China, EU, Canada, and Mexico. About 60% of what the US imports comes from those regions. And it's saying to those guys, if you want to benefit from that economic activity that we're exporting to you guys, you need to do certain things that we agree that we want to happen. So for it's direct borders, Canada and Mexico, it's saying get a better handle on drugs coming into our country or illegal immigration. So it's weaponized that trade for those regions that make up a significant part of their imports. Now, tariffs can be a double-edged sword. So what I've tried to do on this slide is say, okay, the US imports about $2 trillion worth of stuff from those 4 regions. As I said, it makes up about 60% of what they buy. In terms of the overall spending by US citizens, about 10% of what they buy comes from those 4 countries. And so if they slap 10% tariffs on those goods, the cost of things that Americans buy will go up by almost 1%. If they slap 25% of tariffs, the cost of things that Americans buy will go up by 2.5%. It's a very simplistic view of things because obviously, if you're sending something into the country that costs, $10 and they slap, $1 of tariff onto that, it's not to say that the consumer has to pay that full extra dollar of price. A lot of it gets absorbed by other parts of the channel. So the producers, the guys who are sending that stuff, will have to absorb some of that tariff. The importers, the exporters will absorb some. In some instances, consumers will say, well, I'm not willing to pay 25% more for a washing machine from China. I'm not just going to buy it from Vietnam. Or some consumers might say, I'm not willing to pay 25% more for this thing. I'm just not going to, I don't need it. I'm not going to buy it. So the reality is that the impact on inflation will actually be much lower than these numbers, but there will be some impact to inflation, and consumers don't like inflation. So the US has got to be really careful about this because the US is a heavily consumer-driven economy. The consumer is, 70 odd percent of economic activity, and when the consumer gets spooked, the economy is very likely to fall over. So we want to know how those US consumers are doing because remember I said, if the US economy struggles, we're going to be very hard for us in South Africa not to struggle at the same time. And so there's a lot of data on how the consumer is feeling out of the US. In fact, the US has a plethora of data on all sorts of things. But just before we talk about the US as this kind of homogenous group of people, they're actually fairly divided. So about half of Americans, what I've gone and done on this slide is just taken data back for 80 odd years for all of the US elections over that period. Anything in blue is the proportion of those election votes that went to the Democrats. Red is the stuff that went to Republicans. There's little gray in the middle here for some independent candidates. And this is the 50% line here in black. You can see the US is very divided. There's roughly 50-50 split between Democrats and Republicans. So they're not all feeling the same about what's happening in the White House at the moment. And interestingly enough, you can get some amazing data, as I say, out of the US. So consumer sentiment is one of the things that we measure because that gives us an idea of how consumer spending decisions going forward are going to happen, which obviously, as we said, has a pretty big impact on the economy. So the gray dotted line, first of all, here is US consumer sentiment, rolled over a little bit. The red and blue lines they actually have consumer sentiment data in the US down to the level of which party you vote for. So what I've done on this chart, and it goes back almost 10 years, is said, how is the consumer feeling in aggregate, but how are the individual sort of political parties' consumers feeling as well? So white areas here are when Democrats are in power. Gray areas are when Republicans are in power. So this would have been Obama, Trump's first period over here in gray. Then we had 4 years of Biden, and now we've got a little bit of Trump at the end here. And it's obviously not particularly surprising to see that when your president is in the White House, you're feeling much better about how the economy is going to go. During the Obama era, the Democrats were feeling much better about the economy than the Republicans. When Trump came in, that flipped around. When Biden came in, flipped around again, and vice versa. And in aggregate, it actually made very little difference to consumer sentiment. But what you have seen lately is consumer sentiment has rolled over. Even Republicans are saying as consumers, they're feeling less excited about the economy now than they were at the start of COVID when they had a Republican president in the White House. So it's actually pretty bad. And Democrats are feeling, worse than certainly at any point in the last decade or so. So this is important to watch. All this change is creating chaos. It's creating uncertainty. If that uncertainty starts to weigh too heavily on the consumer, it can start to have a bigger impact on the economy and slow things down. And that's what we're kind of really watching for from all of this noise that's rippling its way into impacting us here on the southern tip of Africa. Just to land this plane, my conclusions from all of this stuff are to say the ripple effects from outside our borders are meaningful. You know, most of what will happen to our currency, our economy, our stock market is dictated by what happens outside our border. We need to pay attention. A strong US economy is actually probably one of the best things that can happen for US investors. US inflation is not great. We don't want tariffs out there. It means higher rates, tougher for South African rates to drop in that environment. I would say, you know, consumer sentiment is telling you that Trump needs to knuckle down and make sure that he keeps his own consumers happy at this point. So wouldn't be surprised to see a big shift to more kind of domestically feel good policy type things happening, less focus on what's happening outside of the borders. Frankly, South Africa could do well to do the same. You know, the US is not a meaningful, not our biggest trading partner, but as I said, you know, exports are important for us. We can't afford to score any own goals from that perspective. And that's it from me. So, Jim, I don't know what you want to do from here. If there's questions or.
Hey, thank you, Peter. Well, you've used your time perfectly, so I'm going to have to let you go. I just wanted to ask you this quick question. You know, being an economist, would you say that the sooner we fall behind, the more time we have to catch up?
I'm going to just say yes to that, Jim. Yes, that's absolutely correct.
Yeah. All right. Yeah, I just wanted to check that with you because I believe that's what they're thinking over at the Treasury at the moment.
So, yeah. No.
Anyway.
Hard one.
Well, thank you, Peter. We're going to now switch over to London. So we'll see you soon. Ciao.
Thanks, Jim.
Good evening, Dion. Our next speaker, our next guest is Dion Gous from the Credo Group. Dion, some of you might recognize Dion if you went to the University of Johannesburg to study accountancy a while back. So some of you may have enjoyed his classes. But since a while back now, when was it, 2012 or no, 20 odd years ago, Dion moved to London and has been working with the Credo Group most of that time. He's now the CIO of Credo Group, and he's a qualified charter holder and also a very modest individual because he writes for the Financial Times and was asked to write his first article in March 2020, during which time he was one of the very few people to be positive about the future of the equities market. So you've got a really impressive resume, Dion, and we would be thrilled to hear about your opinions coming from the north to the south. So the first question is, it's been exactly 2 months since Donald Trump was inaugurated as US president. How would you assess the impact so far?
Firstly, thanks a lot for that kind introduction. I just want to say that when I wrote the bullish piece 5 years ago, it wasn't because I had any insight or conviction that the market was about to turn, the next day because the Fed was coming out with their announcements. It was just dumb luck, I guess. I was ultimately focusing on my long-term bullishness because I'll always believe in animal spirits and, free markets and the like. So I just needed to qualify that, but thank you very much. In terms of assessing Trump's first couple of months in power, I think broadly speaking, clearly there are at least two aspects. And the first of which I just want to touch on, which is the political side, and then the second, which is the markets and financial side, clearly much more in my own sweet spot, the latter. From a political point of view, let me say that, I'm no geopolitical expert. I don't really want to be drawn on some of these questions. I have been accused on Twitter or X and elsewhere that I suffer from TDS, some so-called Trump derangement syndrome. I'm hoping not too many people in the audience will say that after tonight, but I fear some probably will. I fully expect that in an audience like this, there's half of the people, potentially more than half, that are big Trump fans. I'll tell you a quick anecdote. I was in South Africa as recently as a couple of weeks ago, and my final lunch on the Saturday before I flew back to London was in Stellenbosch with two of my oldest friends, some of my dearest friends, people that have a good experience in the South African financial markets. At least one of them is a bit of a household name. I won't give the name away in this forum. And I was surprised to see that these two good friends of mine were big Trump fans. So we had a good debate about it. We had a chuckle. We had another glass of, in fact, it wasn't wine because I had to drive, but we had another coffee and we smiled and life went on. My one best friend who lives in America voted for Trump and is a big Trump fan. So I get that. I respect that. I know he's got a mandate. More than half the population voted for him, and I don't want to comment too much on it. I respect all of that. Yeah. From a financial economic point of view, I think I do feel a little bit more strongly. And I think we need to feel free to call it out for what it is. And I think that for the most part, the policies that he has espoused have been disastrous, not only for the economy, but ultimately for markets. And we can see it in stock prices. The stock prices, the stock market is voting with its feet, as it always does. Markets are discounting mechanisms. The S&P is down essentially 10% from its high. The Magnificent Seven is down 20% or more. And ultimately, I think, that tells you a lot of what you need to know. The only positive thing that I'd say is, if you compare Trump after 2 months in office, if you compare him to the typical CEO who starts in a new position at a company with a bit of a turnaround plan ahead of him, it's quite typical to do your most dramatic things as quickly as possible. All those executive orders that Peter referred to earlier. In business, it's called, the kitchen sinking of the company. And perhaps Trump is kitchen sinking in the first couple of months. Hopefully the kitchen sinking will soon be over and then things can return to normality. And maybe I will change my own mind in terms of the effectiveness of some of his policies. So time will tell exactly how these things work out. But for now, I wouldn't really give him a pass from a financial and economic point of view.
Okay. So that's, I think you covered quite a bit of your concerns about the way he's approaching things. So perhaps Peter mentioned the USA consumer. So we talk about the SA consumer or the US consumer and the effect of tariffs, and which Trump is insisting is good for the USA. What do you see there, from a foreign company's point of view and companies exporting to the USA?
Once again, there's a few aspects. I mean, if he would announce some tariffs and stick to them, and as long as the tariffs were not too penal, perhaps you can make an argument that he would, reach his objectives and it wouldn't cause too much chaos. But firstly, his approach is erratic, 20% tariffs the one day and then an exemption the next day, and then new tariffs 24 hours later. That kind of uncertainty that he creates just causes havoc in the markets. And I think that's partly why we've seen the stock market response that we have done in the last few weeks. But also, I think if you just analyze what he says, he and the people around him, the only economists in the world, frankly, or market commentators for that matter, who will agree that tariffs is a good thing for the global economy and even for the US are, and I'm sorry to say this, but they are the people on Trump's payroll. Not any professional investor or commentator agrees with that. There's actually a great quote which a lot of people in the audience would have seen, but if you'll forgive me, I'm going to read it verbatim. It'll only take sort of 30 seconds or so. But a couple of weeks ago, David Kelly, who's the chief global strategist at JP Morgan Asset Management, he came up with this paragraph, and just bear with me. He says, the trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine. Now, I would echo every line of that and ultimately say, therefore, why do these tariffs and why be so erratic in them? And I think what's interesting, Jim, I was having dinner on the weekend actually with some friends, and if you live in London, you end up meeting Americans, that come across to do business and stuff. And some of our friends that we met through my daughter's school are American, capitalist Americans. They're all lifetime Republicans. None of them are Trump supporters. So yes, I'm talking to my own echo chamber. I have to admit that. But I was told the history about one of them, which I never really thought of like that. And that is if you rewind the clock in America by 100 or more years. People would have heard that Donald Trump quotes the time of William McKinley, who was in charge in the late 1800s. When when McKinley was in charge in the late 1800s, and there were tariffs on a number of items and no income taxes, supposedly the world that Trump wants to move back to. 130, 140 years ago, it was a different world. The economy was dominated by the so-called landed gentry, people who lived on their own farms. There were no motor cars. People were using horse and cart. People were growing their own food. And therefore, the tariffs ultimately that came didn't affect these people because they were essentially self-sufficient. So the tariffs that created price increases on whatever goods were imported ultimately trickled down to have an effect on the poorest people who were not landed gentry, who were not self-sufficient, who did not grow their own food, for example. And therefore, in response to that, to make it more fair, to make the burden a little bit more equitable, they decided to drop the tariffs and to increase tax and ultimately have a progressive tax system so that the rich people who can afford it pay more tax and the poor people who cannot afford it pay less. And essentially, we have a version of that system 100 years later, not only in the States, but in South Africa as well. And that makes economic sense. It makes sense from a fairness point of view. And somehow Trump is ignoring that, and he wants to go back to where we were 130 years ago.
So when Trump says that tariffs will make the USA richer, is he really saying that the rich people will get richer? Is that?
I absolutely do. You only need to look at a picture of his inauguration where you've got all these multi-gazillionaires who stand next to him, when he takes the oath. I mean, it's not only Elon Musk, it's basically the captains of industry from every other of the Magnificent Seven. And that's what's really been the Trump approach. The billionaires will get richer, but ultimately at the cost of the poor people. And I think, frankly, this insight is starting to filter down to the US population, and that explains that little squiggly gray line on Peter's last slide that he showed, where he spoke about consumer sentiment. The absolute level of consumer sentiment, regardless of whether you're Republican or Democrat, and regardless of who's in charge, on that slide that Peter showed was the lowest it has ever been, for the period of that chart. And I think people are starting to.
Well, I have to try to look for some silver linings. Do you see anything positive on the Trumponomics USA experiment?
There are a few things. I mean, let's talk about Doge and Elon Musk, and without commenting on Musk and the way that he operates, I think it is clear that there was wastage and that a lot of that should be saved. You only need to look at the way that it's filtering around the world. We had news in the UK in the last week, as you may know, Jim, that Keir Starmer and his cronies are trying to sort of get rid of all sorts of waste within government. For example, NHS England is being abolished. Now, NHS England is not the NHS. NHS England is a quango, a sort of an NGO that's responsible for managing the NHS. Bear in mind that the biggest employer in the UK is the NHS. It employs more than 1.5 million people. And there are tens of thousands of people there that will be taken out from the cost line because they're essentially professional managers, and ultimately that money will be spent on treating patients rather than professional managers. So that is an impact in the UK. Now, the reason I'm mentioning that is I think they're taking a leaf from the American book. So much of what Doge does, not all of it, but much of what Doge does, I think we can say is a positive. In addition, there will be de-inflation. In addition, drill, baby, drill. We've heard Trump say that. It means energy prices will be lower. There are a number of positives that one can focus on. So it's not all doom and gloom.
Yeah. Well, some of his supporters might suggest that Trump is playing 4D chess, while the real intention of the tariff policy is just to weaken, his negotiation tactics, basically, with the objective of making the U.S. debt burden more bearable as one outcome.
That's a strong argument. There are lots of people who are saying that. So just in a nutshell, if the economy does weaken, it means ultimately it will have an impact on lower interest rates because those things go hand in hand. That's essentially economics 101. And just in the rest of this calendar year, something like $7 trillion worth. That's about 20% of the US government debt burden. About 20% of that needs to be rolled, needs to be refinanced this year. And if that gets rolled at an interest rate of, let's say, 3.5 or 4%, rather than the current 4.5 to 5%, that 1% differential, will save hundreds of billions in terms of interest expense. So I get it. And there is an argument that the 4D chess will have that favorable outcome. The counter argument I would suggest is that it's essentially self-defeating because it will only happen because the economy is slower, because economic growth is weaker than it might have been otherwise. And the crude analogy that maybe I would use, it's a bit like to say that I know we've just had the Cape Cycle Tour a couple of weeks ago, and I'm sure that a number of people on this webinar would have done that. It's a bit like a champion cyclist who's saying, listen, I'm going to chop my one arm off, because if I chop the arm off, I'm lighter, and therefore my power to weight ratio on the bike increases. I can go faster. Now, that may be theoretically true, but it comes at a loss of control. So bring it back to the economy. Why would you really want to contract the economy? Because ultimately, the most efficient way of ultimately covering that budget deficit is through strong economic growth and the taxes that you can gain from it. I'm not sure. I actually made one note from Peter's presentation. I was watching, it was very good. And one of his, the heading says that the easiest way out of a budget deficit is economic growth. That's I'm quoting Peter here. It's in the slides. And to that, I can just say amen. And therefore, yes, 4DHS could have the benefit that you suggested, but I think the counter arguments are stronger.
Okay. Now, it has seemed in recent times that the U.S. government thought that it was responsible for fueling growth through deficit spending. Is that a sustainable thing? Will they need to eventually balance the budget?
Well, Jim, I mean, this is ultimately this is a question for economic theory, and I know in our pre-discussions, you mentioned the sort of trade-off between the so-called Austrian school and those who subscribe to modern monetary theory. Now, the reality is that in the world that we've seen in modern times, certainly my whole career, it's all been modern monetary theory. The Austrian school that essentially focuses on small government and balancing the books and maybe resorting back to a gold standard. The last time we saw that really was in the 60s. More recently, we do live in the world of floating exchange rate, of fiat money, and ultimately creating money, to fund these budget deficits. The whole word fiat, for those of you who didn't realize it, if you go back to the Latin, is just let it be. So money gets created by just letting it happen, whether it's through a government agency or frankly through a bank. There was quite an amusing clip from Elon Musk a couple of days ago that a lot of people would have seen, where he says that he's found something like 14 magic computers that create money out of thin air. Now, the irony is there's much more than these 14. Practically every bank in the US has a magic money computer. When you and I go to the bank and we ask for a mortgage, there are only two things they're interested in. They're interested in our own sort of credit worthiness. Do they think we're a good credit? And they're interested in the value of the house. Now, ultimately, they don't want to take back that house. So the credit worthiness is actually more important than the value of the house. But if both those boxes are ticked, they will give you the loan. They will credit your account and they will debit the asset in their books. And the money is created out of thin air. They don't go to the accountant first and say, listen, do we have an extra R1 million to lend to Jim? They simply don't do that. Yes, on a quarterly basis, they need to consider capital requirements and the like, which effectively places a constraint on how much they can lend next quarter. But for each individual loan, money is created out of thin air. That's simply the way it works. That's the way it has always worked. So budget, will be financed like that. It is sustainable. And if you're the US and you have the world's biggest and strongest economy, like I've had for all of my lifetime, and you have it going forward, which I believe they will still have in spite of Trump, then this is ultimately sustainable, especially because you are creating money in the world's reserve currency. Now, the big danger is that the dollar stops being the world's reserve currency. And there are some people that bang the drum of de-dollarization. I frankly don't see that as a real risk in our lifetime. Yes, perhaps slightly lesser dollar dependency. These things always ebb and flow. But the dollar is so dominant, and in my view, is likely to remain dominant way after we've seen the end of Trump. Bear in mind, in 3 years and 10 months' time, we are likely to see the end of Trump. I know there are people that say that, he's going to be president forever. I think the Constitution is stronger and more sound than that.
Yeah. And then, so you've mentioned the dollar, and one of the charts Peter showed was most currencies have weakened against the dollar. We're not the worst, strangely enough. It's always good to see that the Aussie and the New Zealand dollars actually done worse recently. So you to sort of kind of repeat that, do you feel that the dollar's pretty stable for a very long time going forward?
Well, the short answer is yes. I mean,
Strong.
that is being tested. Now, the dollar was extremely strong. It was at its high point maybe a month or so ago. You know, that I think was the second last slide that Peter showed. Since the election, the dollar, as well as interest rates, as well as what was the other one? The market, of course, those three. They were all trickling up until about Christmas, early in the new year. And then they all started rolling over. They really started rolling over in January when the market realized not only that Trump is or looks serious about tariffs, but also that he's a little bit chaotic in terms of his approach to it. The fact that some of the numbers are so excessively high. So the dollar has rolled over. I think the number that Peter showed was that the rand had appreciated by about 3% in the last few weeks, and most other currencies have done better. So yes, certainly in the short term, you know, I think, is this trend over? Are we at the bottom for the dollar today? Nobody knows. If you just extrapolate the trend, the one that Peter showed, it would appear that the dollar has some way to fall before it bottoms and goes the other way again. So ultimately, my positive view about the dollar is not trading. We're not traders at Credo. You know, we invest for the long term, and therefore, if you've got dollar-denominated assets, if you own shares that ultimately are listed in the States, are measured in dollars, and have a big portion of the income from the States, I think as long as it's a good company and the business model is not threatened, those are sound long-term investments. And the last thing I would do is to sort of blink at the bottom and to sell at exactly the wrong time, which might be now. It might be in a week or two's time when the market is even weaker. I'm not a US bear or a dollar bear on the long term. I'm definitely not.
Yeah. So we saw a very strong U.S. market last year. So where do you feel that the prospects for global markets within this framework that we're living in at the moment?
Look, Jim, this goes back to the conversation at the beginning in terms of you know, the piece that I wrote 5 years ago. If you ask me my prospect for markets, my answer will always be the same. And it's, you know, I'll give it to you now, I'll give it to you in a week's time, I'll give it to you a month's time. You can wake me in my sleep, I'll say it again, I'll say it in a year's time. And that answer is that I'm always long-term bullish. And I'm an equities guy. I believe in things like animal spirits and human endeavor and creativity. And as I've said on multiple occasions, when you buy the shares of the best companies in the world, you get people like Elon Musk, you know, for all his faults, and Steve Jobs, and Bill Gates, and Mark Zuckerberg, and the list goes on. You get these people to work for you while you sleep. And that's what you do by buying equities. And in the short term, there could be disruptions. And in the short term, some of these companies could be overpriced and they become more reasonably priced. But in the long term, those kind of companies are going to make you money as long as you stay the course. So I'm bullish for the long term. I've got no view about the short term. I don't know when this market is going to bottom, but I'm certainly not a seller. If people have cash at hand, I think I think you can buy shares in the short term at prices that are 10-20% cheaper than what they were a month ago when the sentiment was a lot better. And yes, they can become even cheaper. As I say, I'm not making a short-term tactical call here.
Right. Well, that's what you guys do in the global equity fund. You know, you're always obviously looking for the next investment, and then obviously selling them when they're looking at overpriced. Then going back to Elon Musk and Doge, obviously he's a big favorite amongst South Africans being from here. What do you think are the positives and negatives of trying to reduce the U.S. government by as much as 50% of the employees?
As I said already, Jim, I mean, clearly there's some good in it, and that should be celebrated. I think we can criticize the style in which he's doing it, creating havoc everywhere, firing people and then calling them back in some cases. I think from a style point of view, not many people will do that. I saw an interview a week or two ago with Michael Lewis, the author of Liar Spoken, a number of other great books that people in today's audience would have read. And he said that if I were to call 12 of America's top CEOs and I were to ask them, you know, to just give me a pass or fail for the way in which Elon Musk is going about, he says, I'm convinced that it'll be 0 for 12. Not one of them would agree that he's done it in a good way. But ultimately, the way in which he does it is less important than what he's doing. And I do think there is some damage being done. One of these friends that I mentioned that I had a conversation with on over the weekend, one of my American friends, is involved in the pharmaceutical industry. And his clients are ultimately people that are responsible for developing cancer drugs. And I'm talking about new drugs, you know, it's at the cutting edge of essentially curing cancer. And as he says to me, these companies that he's trying to sell to, he's supplying equipment to them. The companies that he's trying to sell to, their activity in terms of new developments, in terms of R&D, and ultimately bringing new product to market, which will save the next life, it is totally being stopped at the moment. Why? Because everybody at the FDA that they used to deal with has been fired. There's been 10,000 people at the FDA that's been fired. And yes, some of them will get their jobs back, but maybe it'll take a few months, maybe it'll take a year or two. In the meantime, companies are affected, and in the meantime, patients are dying. So those are some of the real impacts. There was an article over the weekend in the New York Times about people in Africa that have died from HIV and other reasons because US aid has been cut off from them. So the humanitarian aspect, I think, is vast. So there are lots of nuances here, but can some money be saved? For sure. Are they going about in the right way? I'm not so sure. Can I say one more thing, Jim, if I may?
Yeah.
I would encourage people to go and look at the US debt clock. Now, there's a website called usdebtclock.org, which has always been around. It'll show you that today the debt is about 36 trillion, and it's live. It keeps on running up. You know, by each second it goes up by a few dollars. But since Musk has been around and Doge has been created, there's a new section on that. I've been looking at this US debt clock for years. It's one of my hobbies. And there's a new section which is the money that they've saved. Go and have a look at the money they've saved through Doge. According to the usdebtclock.org, whatever sources of data they use, Doge to date is projected to have saved something like $200 billion, just over $220 or $240 billion, which sounds like a great number. But bear in mind one thing, the wealth impact of what you've done to the stock market, and therefore the effect on the typical American and the consumer sentiment, is a lot worse. Why? Because depending on which date you focus on, the American stock market is worth something north of $60 trillion. About 80% of that is in American hands. So call it in round numbers 50 trillion. And when the stock market goes down 10%, it means American investors have lost 5 trillion and they've saved 200 billion through Doge. The one dwarfs the other. So yes, Doge is not a terrible thing, but it's actually not so impactful in the scheme of things.
Great. Now, bringing this back to South Africa and our audience, within all these global changes, what are the main positives that you might see for South Africa?
Well, once again, I think Peter warned on his final slides of some of the risks, so I won't repeat them. Yeah, and I've thought about this because I suspected you might ask me for that to try and end on a high, Jim. And and there are two that I'll mention. One maybe more lighthearted than the rest, and I'll finish with the lighthearted one. I think on a serious note, 5 minutes ago I mentioned aid and the fact that there's a lot of less aid going around, including to South African institutions. And I think, yes, there'll be short-term pain, but perhaps it'll make us more self-sufficient over time. I grew up in the old South Africa, you know, when we were proud of the fact that we had a company like Sasol that could create, you know, fuel from coal, something that apparently the rest of the world wasn't done. That was held up as an example of South African self-sufficiency. Now, maybe that's a bit of a tired example today, but I think self-sufficiency for South Africa and for other parts of the world will need to increase and will ultimately be a good thing. And then on a slightly more lighthearted note, I can think of one product line that's probably going to benefit from these sanctions. People would have seen that about a week ago, Donald Trump announced 200% tariffs on wine and related products from Europe coming into the USA. Now, even if AGOA gets abolished and there are tariffs on South African wine, they are unlikely to be as high as 200%. And therefore, and bear in mind, the best South African wine is an amazing bargain compared to its counterparts in the rest of the world. South African wine's already cheap. Quality wine's already cheap in relative terms if you buy it in hard currency. And if you then slap a 200% tariff on French champagne, then that battle of, you know, Graham Beck bubbly that you're trying to export to Washington is going to look tremendously cheap. It could be great for wine producers. So I'd encourage people listening to this call at 7 o'clock in South Africa, go and pour yourself a glass of your best wine that you've got in the fridge, compliments of Credo, because it's going to become a lot more expensive because America is going to be queuing up for it.
Yeah, we may not even be able to get it if they the producers can sell it for a lot more in the States, yeah, or anywhere else. Well, Dion, that was a great way to end it, and I think that's, you know, there are no doubt and quite a few positives that will start to surface as we move into 2025. If our government can sort of just maybe get out of the way a little bit and let the economy grow. Well, thank you, Dion. I appreciate your time, and we've reached 7 o'clock, so I'm going to wind it up now and say to all of our audience, thank you for attending. Please let us know in your comments if you have any questions or there's anything you'd like us to cover in the next webinar. And we will be looking forward to this. Will be available, by the way, we're recording it, so it will be available through a link on our website, and that will be posted sometime later this week. So thanks, everyone. Go and have that glass of wine and enjoy the best that South Africa has to offer. Thank you very much. Good night.